When it comes to bear markets and bull markets, former Fidelity Investments fund manager Peter Lynch says, missing the bottom on the way up won't cost you anything. Missing the top on the way down, that's always expensive. For the best personal finance content, subscribe to my channel and hit the bell icon to be notified when I post a video every Friday. The stock market is looking pretty good right now, but that wasn't always the case. The stock market wasn't looking very good about a year ago. The Dow Jones Industrial Average, or DJIA, reached a high of 29,551.42 on February 12, 2020. It went on to lose nearly 11,000 points in one of the most extreme bear market examples as it sank to a low of 18,591.93 points on March 23, 2020, during the earliest weeks of the worldwide health crisis. Many investors lost money early on. This scared some new investors out of the market and kept potential investors away from the market. Today, things are a bit different. The market has rallied back and is currently at 31,437.8 points as of this writing, beating its pre-illness high by nearly 2,000 points. Keeping our focus only on the replaceable, many people lost money and even their jobs in 2020, while a few managed to increase their net worth, in some cases dramatically. Pew Research says that in 2020, the median amount invested by young adult households is relatively small, $7,700 among those younger than 35. Investopedia tells us that the average 2020 return on the S&P 500 stock as of December 14, 2020 is 8.94%. Meaning that if the average 35-year-old investor were able to hold on to her investments, she would have seen an increase of $688.38. Compare that to America's 614 billionaires, who USA Today tells us grew their net worth by an astounding $931 billion in 2020. As a quick reminder, I'd like to see you invest in the channel by clicking the like button and helping me reach my goal of 50 likes. Also, if you're enjoying my content, consider subscribing so I can help you with personal finance and economics concepts every week. Subscribing is free, and you can always unsubscribe later. You may be considering investing, but you may feel doubtful about the stock market. I wouldn't blame you. There are always questions floating around like, are we in a bull or bear market, or will the stock market crash in 2021? Add that to investment apps crashing or refusing your trade, and it can create an environment for a lot of confusion. Some of you might be wondering how you can tell if we're in a bull market or bear market. I'll be happy to define bear market and define bull market for you. Bull market definition. Some of you might be wondering what a bull market is. A bull market can best be defined as a period of or expectation of rising stock market prices. This financial market is characterized by economic growth, widespread optimism, and stock market indexes surging upwards of 20% from a recent 20% decline. A bull market is also marked by a growth in investor confidence. Our most recent bull market, lasting 11 years, indicates that many new investors have only directly experienced a bull market. Many new investors only began trading when apps like Robinhood emerged on the scene in 2013. Bear market defined. Bear markets are in stark contrast to bull markets. Bear markets occur when stock indexes have fallen from recent heights by 20% or more for at least 2 months. This climate is characterized by widespread pessimism among investors and gives us rise to potential economic recession. I've seen articles that correlate a 10% drop in the stock market to $6 trillion in wealth lost. If that holds true, then a bear market reflects the loss of $12 trillion of wealth. There's no telling how long a bear market can last. It can last from just a few weeks to several years. The most recent prolonged bear market in the US was the Great Recession. It lasted for 17 months between 2007 and 2009. During that time, the S&P 500 lost 50% of its value. If you're new to personal finance, it's likely that you've never invested in a bear market. To borrow an idea from a once popular TV show, new investors were born during the long summer of the bull market. With all the talks of market bubbles about to burst, the question is, has winter truly passed? Investing in a bear market. What can you do during a bear market? Many investors can't weather the losses they sustain and wind up selling their stocks for a fraction of their purchase price. Doing this allows them to calm their fears of losing everything in the stock market. This also locks in their losses, making them real and permanent. The idea of locking in your losses might work well for some, but that's not what I do. Remember, I am not a financial advisor, and none of this should be taken as financial advice. I can only tell you the strategy I've implemented in the past. The most important thing to do is to stay employed. You can't continue to invest if you've lost your job. The bear market in 2020 led to a recession, as is often the case. If that happens again in the future bear market, your employer may begin laying off staff. You'll need to increase your value to your employer. This may mean taking on more responsibilities, working longer hours, or learning new skills at no extra cost to your job. Be sure to speak to a manager to see what extra responsibilities or avenues for growth are available to you to make you more valuable to your employer. Once your job is as secure as you can get it, the next big thing you can do is continue implementing strong personal finance fundamentals. You'll need your emergency fund more than ever investing in a bear market. It's also essential that you pay off all your high-interest debt. I've spoken about these fundamentals previously. I'll leave a link to a video outlining how to build an emergency fund and pay off your debts in your card at the top of the screen. Now that you've taken care of your debts and your emergency fund, it's time to invest. Be sure you're taking advantage of your employer's 401k program. Invest up to the company match if offered. Many employers offer a 50% match up to a certain percentage of income. Taking advantage of the employer match is like your employer giving you free money towards retirement. Lastly, you should take the time to invest outside of your 401k. This is where it's possible to really grow wealth if you invest intelligently. I don't like buying shares in individual companies, even in a bull market. My strategy is purchasing index funds that track the stock market or entire industries. Indexes are like mutual funds in that they offer a high degree of diversification at a comparatively low cost. They differ from mutual funds in that they are not actively managed and therefore come with very low or even no management fees, and that they've outperformed actively managed funds for a decade. Some popular indexes include Vanguard 500 Index Fund, VFINX, Vanguard Total Stock Market Index Fund, VTSMX, and the Fidelity 500 Index Fund, FXAIX. Always do your own research, as these are not purchase suggestions. This is simply a list of the most popular index funds on the market. Warren Buffett likes to say to be fearful when others are greedy and greedy when others are fearful. Investing in a bear market is a time to be greedy, but in a safe and calculated fashion. It's wise to devote at least 15% of your income on investing between your 401k and your other investments. Stocks will be at their cheapest. All you have to do is purchase at regular intervals. This is a practice known as dollar cost averaging. Bull markets are defined by economic growth, widespread optimism, and stock market indexes surging upwards of 20% from a recent decline. Bear markets can occur when stock indexes have fallen from recent heights by 20% or more for at least 2 months. Bear markets are often followed by economic recessions. New investors who have never invested during a bear market need to ensure that they stay employed and maximize their emergency funds while eliminating high-interest debt. It's also critical that new investors take a company match on their 401k and set aside 15% of their income to invest in index funds that track the market. Now that you know so much about investing in a bear market, you might be motivated to invest. Invest easily and effortlessly using Acorns. With Acorns, even your spare change can grow into a mighty yoke. Explore the new Acorns Early feature and help your children save for their future while you shop. Use my link in the description and get your child started investing in under 3 minutes. If you're a YouTuber or are considering starting a YouTube channel and you like my editing style, click the link in the description to get a free trial of my software. Thanks again for all the support in the comment section. And a special thanks to Fit for Freelance, who is our new comment section champion for this week. Join him as he helps you make health an engaging part of the entrepreneurial journey. Link in the description. Make sure you join in the discussion for a chance to have your comment featured. I read and reply to all the comments I get. Check out these videos on your screen on how to improve your finances. If you like this video, hit the like button. It helps out a lot. Be sure to subscribe and share the video with your friends. Check the links in the description for offer information. Thanks for watching, and I'll see you in the next video.